The other question we get quite often is, how do we decide between how much to allocate between equity and fixed income based on your age, right? So if you're in your early part of the 20s or younger in terms of your age profile, we recommend, and it's the standard, that we allocate a larger component to equities. And over time, as you age, your allocation towards equities reduces over time. The standard global equation that they use, a benchmark, it's not a given rule as such, but a benchmark that they use is your equity allocation being 100 minus your age. For example, if your age is 20, you allocate minus 20 or 80% in the equity component, whereas 20% is allocated to fixed income, right? Now, I would say that given that Sri Lanka having relatively higher rates, interest rates, we can treat this equation to say 90 minus age for equity and fixed income allocation, right? For example, if you're 70 years in terms of age, your will be 90 minus 70, which is 20% to equities and 80% to fixed income instruments. So as you age, you're targeting more stable fixed income, because you don't have any other sources to kind of compensate you in case there are uncertainties and things that you are not be able to predict. From a saving perspective, break down your investment goals into your working phase and your retirement phase. In your working phase, which is up to 60 years in Sri Lanka's case normally, you look at adding to your pool of investments, which is contributing, like saving to your cash, focusing on asset growth, looking at how you can grow the assets above the benchmark returns, right? Which is why I said, look at equities, look at long-term products, and you have the opportunity to kind of that cushion to invest for the long term. But once you cross 60, the way that you look at it will be different, right? Because you're not going to be saving, you're going to be withdrawing, right? From the age of 60, if you're retiring, you'll be withdrawing from the pool of funds. You'll be net cash drawing down. And also you have to focus on return certainty, because you don't have the option of being able to protect yourself against volatility, because you don't have assets that you can add to your equation, right? And also when you're in retirement phase, you look at short-term investment products rather than long-term investment products, given that your longevity is less at the point of retirement, right? So your investment profile changes based on whether you're in retirement phase or the working phase, right? And it's not a straight line curve. It's a gradually reducing curve where you focus growth at the beginning of the cycle and looking at return certainty towards the part of the retirement, right? So this is a breakdown of how you can look at your spending and asset allocation if you're in your retirement phase, right? This is after, let's say 5 years, right?